Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to accomplished UK fund manager Abby Glennie of Aberdeen Investments. So welcome, Abby.
Hi, Paul. Morning. Nice to see you.
Yeah, well, it's great to be back on the show. Just hot from your trip down France, but we've had a lot of going on the market since we last spoke over the first sort of like half of 2025. Not least the Trump trade tariffs. More recently, the Israel-Iran conflict, Ukraine, Russia, of course, and the recent spending review. So throwing all that at the market, they've been surprisingly resilient. What's your sort of outlook for equities in the second half?
Yeah, markets have been resilient, haven't they? And it's interesting. We were talking about that just in terms of even the last few days, macro volatility. But, maybe markets are almost getting used to that being the new norm. I think if we look at some of the different regional indices this year and you look at how strong areas like, in particular Europe, but also UK have been, I think that within equities, we're definitely seeing more positivity towards Europe and UK in particular, actually. And, if I speak to any sort of strategists, economists, that is the areas that they are highlighting as the most attractive in terms of outlook and also but in terms of valuation. So I think people are still showing some concern about the US market. For equities overall, though, I think it would be positive for markets everywhere to be doing okay. I think people easily take fright if, for instance, a big market like the US was to really be challenged. So actually, I think it would be a positive if we saw sort of settling in general and US markets to still do all right as well, but we're definitely seeing much more interest towards UK from clients.
Yeah, and what do you think about the sort of broader economy? Are we going to sort of really having a cooling rather than a contraction of GDP, or how do you see that going forward?
Yeah, I mean, I think the UK is looking all right, isn't it? It's the data might not be sparkling, but it's actually pretty consistent. And one of the interesting things I was looking at was, when we talk about sort of 2% GDP outlook, that might not sort of set people's hearts alight. But actually, when we look at sort of a previous decade from sort of 2010, that's around what the UK did. And, that is actually quite a normalised level. And we saw UK stock markets do really quite well in that period. In fact, I think until about 2017, they were outperforming the US before the US sort of really kicked into gear. I think there's definitely risks out there, though. So I'm sure we'll talk about this as we go on, but just level of uncertainty from companies. And there are, lots of areas of downgrades still.
Yeah.
So I think, the sort of thing people look at as well is potential tax hikes later in the year, and how that might affect the consumer, which is a big thing for UK economy.
Yeah, it was absolutely right. Okay, good. Well, one sector that's done particularly well for you over the last 12 months and very well for everybody is defence. And you've got two stocks there. Let's go for the first one, Avon Technologies. It makes sort of like gas masks and respirators for the armed forces and also first responders, plus rebreathers as well. Just won actually a contract, I think it was announced yesterday, with the Ukraine of about a £10 million gas mask contract. How do you see this one? It's not cheap now. I mean, like all of the sector, it's sort of 25, 30 times P, but what's sort of like the trajectory going forward?
Yeah, so I think, we've both owned the two defence stocks you're going to sort of talk about, so Avon and Chemring. We've owned them both for quite a while. So this isn't like playing a defence theme. These are things which we actually, found stock in their own right for what they were doing. And actually, I know they've both done well, but look at how well some of the European things have done. So actually, the UK ones in terms of a revaluation haven't been nearly anywhere near a lot of the big European names. One of the things I really like about Avon is that it's gone through a challenge period. This chart looks great, but if you went back further, it had a very tough period. And we've seen a new management team come in, and yeah, that one's not quite as pretty in the long term. But I would say it knows what it did wrong in that period where shares went down, and new management came in, and really there's a turnaround story in this business. So that's been key, and I think that's still ongoing, and they're still proving that. So when we first bought this maybe about a year ago or so. Definitely valuation was one of the aspects that we had to look at when we were looking at the sort of fundamental investment, because it's not cheap. But when you look at the growth it's achieving, and importantly also the margin improvement from all the self-help, then I think once they've sort of proved that, which they're, I would say, just getting to the stage of, I think there's a lot more they can do with the business. And at the same time, look, now their end markets are more favourable for them, and they're doing really well at winning contracts.
Yeah, I think they're doing they're closing a factory, aren't they, in the States, and migrating the volumes. I think is it a Cleveland facility or something like that to help to improve margins.
Yeah, and I think, you talk to them about when they came into the business and walking around the factories, and just, to them, a lot of changes that could be made in operational aspects of the business. I think one of the things that's interesting about this business actually is quite how global it is and has the potential to be. So in terms of, yes, look, it's got, lots of US and UK sales at the moment, but increasingly we're seeing other sort of armed forces and the like wanting to have access to the same quality of products as these sort of main defence geographies have.
Yeah, well, let's move on to Chemring, because obviously the NATO is saying that it wants to. In fact, I think it's got a NATO. It's got a NATO meeting, I think, in The Hague or something this week. So it's right, very central to the thesis. But they're looking to increase spend from current 2 to 2.5% to 3.5%, and I think Trump has been saying he wants 5% of GDP. So there's obviously a big tailwind, and I think. Chemring, for people, they basically do energetics and a bit of sort of like I think it's plastic explosives and decoys, and they have that huge cybersecurity division rogue. Putting all that together, again, the shares have done fabulously. When do you take profits on these, or you just keep running them, because obviously they keep going up?
Yeah, I mean, I would say the same about this one though. Like, if you look on a short-term chart, you probably think, oh, shares have done really well lately. But actually, if you look a little bit further back, they had gone through a slightly more lackluster period, let's say.
I wish I could find more long-term trends like that. Actually, that was 10 years ago, 2016. Okay, yeah. They were only they were just over £1.
They had a sort of a tougher period in would have been in the sort of middle of last year. Okay. People were a bit less enthusiastic, I would say, about Rotork, and just questioning some of the, actually the order book strength and whether things would come through, and they really have come through. But yeah, this is a business, so I mean, it's interesting. Roke is the part that, if you looked a few years ago and people weren't that positive on defence, what they were positive on is the Roke business, which is more sort of cyber AI stuff, a really, really interesting, high quality business. And almost, the market was questioning, well, why don't you just sort of split this out? This is the great part. Why don't you forget about countermeasures and sensors and information? And now, that business is really, really going strong, and obviously end markets improved. This is another company with lots going on in the background. So, a lot of operational improvement, a lot of capacity expansion as well. And that, I think that's one key thing for actually, as good as your end markets might be, you need to be able to fulfill that demand, and you need to have the quality and service that means that people will contract with you. So these guys have some interesting expansion going on, both in for instance, Scotland and Ayrshire, but also in Norway. They've done some really interesting things as well about funding some of that, particularly in Norway. So I think actually the relationship between governments and defence companies is really important in terms of, now they want access to all these things, but they're going to have to look at perhaps helping finance and fund some of these. So yeah, Chemring we're very positive on.
Yeah, no, it's a lovely model, that is. If you could build a new factory and it's being paid for by the government or the NATO, and therefore you get the upside and they get the product. I mean, that's just like fabulous, isn't it?
Yeah, we could do with more things like that.
Yeah, I know that's sort of like cloud cooking. Like, we don't normally get that in a commercial, but if you, I can understand why you want to hold it. That's for sure. Okay, if anybody in the audience wants to ask Abby any questions, then please put them into the chat box and I'll read them out. We got one from Ben Sharman. He's asking about Hunting, that I think made a little acquisition this morning, £50 million of a sort of like a flexible offshore hose business. Anyway, Hunting do oil and gas sort of drilling components, also tubes and stuff in offshore marine. I think their heartland used to be, there was a Titan drill or something, an onshore shell, but they're a much bigger business now, well cashed up. They've got a lot of orders, but I think it's order flow now is the story. But how do you see it? Shares are quite cheap, actually.
They're very cheap, and good free cash flow yields as well. And we were delighted to see them do that deal this morning, actually. So I spent about 50 million on it. Yeah, they've still got about 40 million in cash that they could spend, or could do a buyback, or can keep in the pot for future acquisitions. What's challenged hunting shares a bit recently has just been the oil price.
Yeah.
And if you look across the sector, a number of things, they have been struggling more that way. I think one thing that perhaps people sort of underestimate with hunting would be they historically think of it as that Titan onshore US business. And actually, if you look over the past 10 years, it's really diversified. They have a big sort of global Asian exposure. They have this business, OCTG, the sort of tubular goods business. So I think the quality of the business and the sort of breadth and diversification is much, much better. Also, if we speak to companies at, even at $70 oil, what sort of activity levels are ongoing? It's still actually quite a positive picture out there.
Yeah.
We sort of personally feel that this is too cheap at the moment. But it just needs to get into a slightly more supportive end market environment, I think, for shares to re-rate and to be doing more action like this, because look, they're throwing off cash flow and they're deploying it, and that deal is earnings accretive in the first year.
No, it looks remarkably cheap. I was just doing the numbers, and even at its current price, it trades at 3.2 times EBITDA. And I was looking at some of its big sort of like oil and gas services, sort of like compatriots, cousins, like sort of Schlumberger and Halliburton, and they're about 5.5 to 6.5 times EBITDA. So like almost twice as highly rated. But one sort of the cloud hanging over it, because I think it win a big Kuwaiti contract not long ago, and given what's happening in the Middle East, I guess people are sort of like just sort of like thinking, actually, do I really want to be in the Middle East at the moment? But hey, what's your view?
Yeah, I don't think that's been the pressure on hunting shares. I think it's much more been just around the general oil price environment. And actually, one of the things we see about hunting a little bit versus some of those other players is that actually there's not many, if any, sort of other peers in the UK small cap space. So if you look at their market cap, I think that is sort of potentially one of the challenges, but also the opportunities is that these other companies you talk about there are big sort of European or overseas oil services businesses, which are just much more on people's radar.
Yeah.
I think it's unfortunately quite easy for people to sometimes just forget about this space in UK small cap, because actually there's not that many of them. What it does mean is, though, when it comes back in focus, then hunting to me is kind of the obvious way to play that in UK small cap.
Yeah, no, I would agree. Okay, another one in that area is Ashtead Technologies. That again is on a bit of a buy and build. It's about 340 million market cap company. Services the offshore oil and gas, largely with rental equipment around the world, I think, but also the renewable sector. Again, the shares have fallen. They're not quite as cheap as hunting, but how do you see this one?
Yeah, so Ashtead Tech is similarly. I mean, it had a really great period. So it almost, I say, the opposite of some of the charts I was saying earlier.
Yes,
it was fantastic, and then it's sort of come off a bit. So maybe let's put that in the context of how strong it had been. And I think also that the oil price environment is definitely one of the big overhangs that investors are finding about this space. And then just its valuation versus some of those other oil services peers is what sort of, when it had done really well, what people were pulling out on. Look, we think this business is very well positioned. Like you said, it is truly global in nature in terms of what it does. It's based in Aberdeen, but global in its customer base is, that every top business that you would want to be servicing. And really great sort of financial metrics, return metrics, capex growth. Importantly, so this is a rental equipment business, but it's the services composition around that I think actually perhaps more investors need to be aware of, I guess, in terms of what you feel you pay as a multiple for a business. This isn't just renting out equipment that is very much a full service proposition. And it's also essential equipment. So, if you're one of these oil and gas services businesses, you're on these offshore vessels for, millions and millions a day, probably. You cannot be short of a piece of equipment. So it's around working with, trusted suppliers like Ashtead Tech to understand the full, product offering that you're going to need to do that job, and having access to that, importantly. So yeah, one thing I guess would just be that they have been very acquisitive. So, the period where shares did really well, they were getting upgrades and upgrades and upgrades. So the environment was very good. They were doing bolt-on accretive acquisitions. Pricing was particularly strong as well. And I think that's one of the things that we've just seen ease off a bit. So although it's still growing very well, we've just seen less earnings momentum, which I think has been one of the challenges.
Yeah. What's the visibility on their order book? Obviously, Huntingham's quite large, lumpy contracts, but I was just wondering, what is this a more short-term type of rental?
It depends what you would call visibility, I guess. So, like if you thought about it as contracted, repeatable revenue, it's not really that type of business. Yeah. But what it is, it knows its customers inside out. So it's the repeatability of it that is really key. And yeah, I mean, they have a very good model as well, in terms of making sure that, customers are paying for the equipment while it is sort of in their hands.
Yeah. Good. Okay, we've got Stefan. He's asking about, I think it was a stock he used to own, you don't know now, is Treatt, which makes flavors and fragrances for the sort of like the drinks industry, particularly sort of like flavored teas and citrus, I think, which goes into all kinds of carbonated drinks and stuff. How do you, the shares have had a bit of a profit warning actually about 3 months ago, have come back a bit, but I think they're seeing quite difficult pricing because the price of, orange oil something or other, I can't remember what it was, a commodity has stayed high even though orange juice prices have decreased, which has meant that they've seen substitution at their customers of their particular product. But anyway, cut the long story short, how do you see Treatt, even though you don't own it now, which says everything, I guess?
Yeah, no, we don't own it anymore. I mean, Treatt's gone through a difficult period. And I think it's one of those things where, yes, there was a destocking cycle, but there was also, a few other challenges. So let's say they had a few headwinds, I think, all at the same time. Yeah. And it was coming from a very expensive valuation as well. So that was one of the things we were definitely conscious about. One of the other things that I would have a challenge about it is just that what I thought was an excellent CFO who's left the business. And we always are a bit uncomfortable in management change situations like that as well. So I think personally, before I would invest in Treatt, again, I need to see the sort of end market and momentum improving because, they've put down a lot of capacity. So, I've been to see their big shiny new facility in the UK, but now you've got to really get the demand to sort of fill and utilise that.
Yeah. Yeah, no, I mean, I think you're right. The markets aren't exactly buoyant at the moment, and I think they said that as much going into the sort of second half. And I guess at these levels, at some point, they'll become a takeover target for a bigger player. But wait and see.
Yeah, possibly. I mean, people have sort of thought Treatt might be on the hit list, but no one's approached them so far.
Yeah, no, you're right. Okay, we've got Steve Waters. He's asking, or Waters. He's asking about CVS Group, basically the veterinary practice business in the UK. Had a bit of a CMA overhang on pricing of vet drugs and services for a long time. Those and pets at home, I think. But CVS is a pure veterinary company. Shares have done reasonably well as the government has started to release some ideas of what the CMA is going to say in terms of it's not quite as onerous. It doesn't appear to be, but even so, it keeps pushed to the right. How do you see CVS going forward?
Yeah, I wonder if Steve was listening to the BBC radio this morning as I was.
And what did it say then?
Well, it was on the BBC News this morning. It was all talking about basically an example of someone complaining, let's say, about having to their animal who still wasn't healthy. And so it's brought up this CMA investigation again, I guess, in the news. Yeah. Look, the news flow we have so far on the CMA investigation, actually, we're quite relaxed about the potential outcomes. I think what it's done as it's gone on is that there's been a lot of feedback to them. And I think they are more aware that this is a complex industry. And it's not an industry you can have set pricing, and actually it's an industry where sometimes you do have to sort of diagnose the patient, and sort of dependent on that is what you would advise that you have to do. The other thing, I guess, at the moment, and actually this was what they were saying on the news at the moment, is just in terms of consumer spending, perhaps some of the more discretionary stuff just doesn't get done. Look, what do we think about CVS? it's interesting. I think it's also one of the stocks which, when I've been at conferences and things like that lately, is getting the most attention. So people are definitely interested in this again, with this CMA sort of overhang still there a little bit. It also got delayed a little bit recently. There was a sort of pushed out deadline.
Yeah.
So that was a bit disappointing. But look, we think the eventual outcomes are going to be okay. They're performing fine in the UK. The interesting part is actually Australia at the moment. So that's where they are sort of really looking to deploy capital. There's sort of no challenges on consolidation there if you look at the fragmentation of the market. So they're seeing really good growth there. It's a high return business. It's unique in what it does. And there's far less of those sort of consolidators in that space. So I think it's got lots of growth potential. So yeah, look, I think it's going to have this sort of CMA overhang for a little bit, but it definitely seems to be on many people's radar in terms of looking at picking some up.
Yeah, no, I would agree. I mean, I remember when the report, initial summary report of 196 pages was issued out. So I jammed it into the Gen AI, asked for a summary of it, a briefer one. And what was quite interesting is that the government or the CMA actually did take on board that if pet owners want a customer person specific service, then if basically they put in onerous pricing in terms of what was equivalent to online, then all the vet practices will go out of business because they couldn't afford to, every single one. And so on that basis, they now realize that actually value add, and if you want to be able to take your pet down to not only get the drug, but to get the procedure or to get the service, to get the care that it wants, actually they're not making massive amounts of money, which I thought was really positive.
Yeah, and I think there's been a lot of pushback from independents, saying, look, if you take some of the actions that have been rumoured, like, we will not exist anymore.
Yes.
So yeah, I think that the outcomes will hopefully be sensible. I mean, the CMA is interesting because I guess one of the themes in the UK at the moment is we've got sort of new leaders in that business, and do I call it a business? I don't know. And more of a hope, let's say, that attitudes towards consolidation might be more considerate before we sort of launch these bigger investigations into industries. I think the challenge for this vet one is that it had already started. Yeah. So we haven't been able to see that sort of positive attitude maybe be applied to this one.
Yeah, well, we can always hope. Keep fingers crossed. Okay, what I love speaking to you about, Abby, is you come up with some stocks that I've hardly ever come across. One of them is Alfa Financial Group. Basically, does software solutions for sort of like asset finance, particularly for its traditional, which is cars, but also sort of like plant and equipment and stuff like that. Shares have just quietly keep going up and up and up. And I mean, what's your sort of your view here? It seems to be doing very, very well.
Yeah, and I mean it's in a tech space as well, where there's been lots of bid rumors and acquisitions, and actually there's potentially less of these great tech businesses going to exist in the UK. So we were delighted to sort of find this one again, where it's showing really positive visibility and momentum. So I think that's one of the key things for these guys is the way that they sort of contract. It's quite big long-term contracts and revenue visibility. Also, they have quite big implementation type periods and delivery periods, but you get paid for all of that work. So when I look at the visibility this has in terms of meeting earnings expectations and forecasts, that's where I feel really comfortable. Yeah. And yeah, the business has really sort of diversified and expanded since it sort of first listed on the market. So yeah, no, I think the visibility was definitely one of the key positive aspects for Alfa.
Yeah. Does it have any exposure at all to this sort of the asset finance sort of like Supreme Court decision, which is coming out in about 3 or 4 months' time?
You mean like the motor?
Yeah, the motor, because obviously they do car. They shouldn't do, no.
No.
Okay, that's good. All right, brilliant. Okay, well, let's move to another one. Let's look at auction tech gain software that sort of like excels in sort of bringing bidders together, plus with auction houses around the world. Sort of focuses mainly on industrial and commercial equipment, which makes, I think, quite a lower take rate, but it mainly also then all antiques and antiquities and stuff like that, and collectibles. And makes a much higher take rate. How do you see this one? The shares did well at the start of the year and then started to slide a bit as people have concerned about how discretionary it is. But having said that, with the tariffs, second-hand values for goods should actually be going up in the States. But anyway, putting all that together, how do you see it?
Yeah, and I think that is one of the things, it's got quite a lot of moving parts in this one, and we've definitely seen that. If you look historically, like sort of through COVID and then post-COVID, because you have sort of volume demand aspects, but then you also have the asset pricing. So definitely when people are talking about tariffs now, and that's the problem, isn't it, is no one really knows what's going to happen with tariffs. But definitely there is that angle that, these used goods, so a big part of this business is in the US, particularly in that industrial and commercial business. Equipment that's already in the US, has the potential to become much more attractive and valuable if new equipment, goes up a lot in pricing. So there's a balance of, like, if people find things tougher, do they spend less, or actually do they buy a second hand and not a new equipment? So you're sort of playing a lot of these macro aspects as well. But yeah, one of the things actually I think this business has done really well is it's had a lot going on in external sort of headwinds and volatility in recent years. But the things that they've been able to control themselves, they've done really well at. So a big part of their sort of growth angle is this sort of value-added services elements that they're looking to do. So looking more at sort of at delivery, at marketing and advertising elements. So where they can really increase that and cross-listing as well between the different platforms. So I have been impressed in their execution on the things that they can control. The things that have been out of their control have unfortunately sort of gone against them in recent years. But, still you look at the sort of financials and a lot of the metrics on the business, and importantly, the valuation. And, I think this has been undervalued. It's one which, I thought you might well have someone approach them. That doesn't appear to have happened so far, but I sort of wouldn't rule that out, because I do think there's a true value here. And, if people look at it versus other sort of platform stocks, the valuation is a bit of a standout.
Yeah. Who do they compete against? Is it the likes of eBay and Sotheby's and people like that, and Christie's?
Not really, to be honest, in terms of what they do. I mean, one of the big aspects when we sort of first bought this IPO and things was actually the move to online auctions. So, but some of those auction houses are actually also their biggest customers.
Yes.
So Ritchie Brothers, for instance, is someone that gets talked about and read across from a lot. But yeah, and one of the things I think is really interesting is actually the benefits of online auctions for sort of everyone involved in the ecosystem.
Yes.
So the auction houses, but also the customers, the service proposition, everything.
No, I would agree. Okay, good. Let's switch sectors. We've got Reg. He's asking about, let's go to the consumer, UK consumer, On the Beach, which is basically a travel holiday sort of like broker almost in the UK. Brand has done very well. Shares have all equally done excellently as everybody keeps on going holiday abroad. But have we at the moment, are we at one stage, will we ever reach peak travel? I don't know. But how do you see On the Beach?
Yeah, so I mean, I think that's one of the interesting things is how people talk about sort of, if you think the consumer's having a tougher time, then actually travel's one of the things that holds up really well. And you see that people still want to go on holiday. That's why they protect their spend. And actually, if we look at the UK consumer, the savings ratio is very high. So, I think people do have the affordability to do this. But importantly, with providers like this as well, they can pay with a very small deposit and can pay up monthly. So, it really makes it accessible. One of the most interesting things, though, for me about On the Beach is the sort of new growth areas. So, look, their core sort of beach holiday market, they've got a big share opportunity. If we think back to sort of things about Thomas Cook and stuff going out of business, there was big share opportunities, and they're definitely capturing a lot of that. But the newer interesting parts of the business, which I think could be really positive for them, are city breaks and Ireland.
Right.
So historically, they had this bit of a challenge with Ryanair, and there was sort of a bit of legal dispute ongoing, and that's now all been resolved. So they now are able to sort of work directly with Ryanair to offer seats on those flights. Now, what that's done, one of the things is it's opened up the Irish market for them. So now they can target outbound from Ireland beach holiday activity. So I think that...
Are there many beaches in Ireland?
No, Irish people going abroad.
Oh, I see. Going to say.
outbound from Ireland.
Yeah.
So yeah, they want to go to the sun just as much as the Brits do.
Yeah, of course.
So that's really interesting for them. But also, I think the thing that some people sort of overlook is actually just having Ryanair on side now. Just what that's let them do in terms of the operational activities in the background and the cost savings that they have there, and actually just the better service offering they have on that. So that's been really important. And then the other thing is they're starting to offer city breaks. And this is really easy for them to do. Like, they've got this tech platform, you're just adding content onto there in terms of flights and hotels. And, for that, they're not really spending on marketing either. So this is really, and they're getting a big pickup from both existing customers and new customers. So I think these are they're all, when you have a tech platform like this, all this stuff can really drive sort of operational leverage if it's successful.
Yeah, no, I agree. Okay, good. In the same sector, we've got Deborah. She's asking about Jet2, obviously the holiday airline stroke package holiday. I think rather than being a broker, I think most of the time it actually offers its own, it either gives its own flight, sells its own flights, or sells its own package holidays, and therefore commits money into hotels and stuff. Again, I think they've done quite well, albeit there's a bit of a overhang, I think, with the so much geopolitical risk and a lot of the airlines having to re-divert out of Middle East, and also the price of crude, which has just gone up slightly for jet fuel, but they're still cheap. Trades at roughly around about just over 8 times PE.
Yeah. I mean, Jet2, it's done quite well recently again. Still trading on about 6 times PE or something.
Yeah.
Like you said. So this is very much, Jet2 is about quality of service offering to customers and repeat customers, and that's what they've been really excelled through, and delivered really well to customers through a tough COVID environment as well.
Yeah.
So we like it. We like the financials of it. We like the repeat business that they get. We like the growth aspects that they have. So opening up new routes, sort of new big hubs in the UK in terms of those outbound, taking market share. And look, we're pretty positive as well on sort of that story about consumers still spend and still want to go on their holidays.
Yeah. What's the sort of USP for Jet2? Is it basically, I don't know, is it, brand, or what is it? Just the way that they perform?
Paul, I feel like you have definitely not been on a Jet2 holiday.
I haven't. No. I tend to go Airbnb. I'm sorry about that. No.
Well, luckily, when we speak to clients, a lot of them have been on a Jet2 holiday, and a lot of them have had a very good experience.
Yeah.
And that's it. Like what customers would say is if you're going somewhere, you might be happy to sort of take another airline's flight. Let's say if you were then sorting out your sort of accommodation and everything else yourself. A lot of people want to do a package holiday. And it's Jet2's quality of service that is really key. So it's where possible, good flight times. Where possible, they do the baggage handling themselves as well.
Right.
So they're sort of controlling the whole proposition. They're controlling you land. It's a Jet2 person there to meet you. It's Jet2 bus to your accommodation. They importantly service all types of standards of holiday. So if you want to go on your so Jet2 indulgent escapes might be the one for you. But similarly, they have a range of pricing aspects to sort of service all types of consumer, and also the type of experience you want. You might want somewhere with water slides and aqua aerobic pool, but you also might not.
Yeah. And have you been on a Jet2 holiday there, Abby?
So I've been on a lot of Jet2 flights. Actually, Amanda, my colleague Amanda, is a big fan of a Jet2 holiday, so she's going on another one this weekend. Yeah.
Oh, okay, cool. All right, brilliant. Let's move on. We've got Tony. He's asking about another one in the consumer sector, but this does reviews. We've got Trustpilot. Bit of a darling in terms of really one of the best places to go for sort of like supposedly independent reviews of products and stuff like this. Shares have went up very strongly last year and then has sort of ticked down a bit. How do you see this one?
Yeah, so what are people? I really like Trustpilot, obviously, because we own it. I think it has a lot of potential, and I think it's been undervalued at the moment.
Yeah.
This year's just been a bit tougher for it, so I think it's got caught up in a few things. Sort of, cheaper value stocks did quite well early in the year in particular, and Trustpilot sort of derated a bit on that. People were a bit worried about, when we saw this sort of US volatility, people were worried about, GDP, businesses going bust in the US, businesses not spending discretionary spend, things like that. So Trustpilot got caught up a little bit in that. And then I think it's a stock which I would say some people really like to sort of bet against.
Yes.
So there are quite often, bear cases put out on Trustpilot. So that's been a bit of a challenge to it this year. Actually, look at their growth, their execution. I think the CEO is excellent. It also has the chair of this is Zilla from previous CEO.
Oh, okay, yeah.
I think she's done an excellent job since she came in, really tightening up the sort of investment spend in the business.
Is there any sort of like regulatory risk at all hanging over the sector? Because it has been talked about sort of like government reviews into things like Amazon Marketplace and the authenticity of so-called, in inverted commas, independent reviews of products and stuff.
Yeah, no, I mean, I think like you never say never in anything really, can you? But I feel pretty comfortable about that in Trustpilot. They actually provide really good documents about how they deal with like fake reviews and all these sort of things. So they definitely have invested in terms of that oversight.
Okay.
Yeah. And I think the thing that's really important about Trustpilot is it's how embedded it becomes in a business. So it becomes like a real flywheel, I think. And I think we see that in the UK, but that's still sort of being created in the US, which is as Trustpilot gets better known and consumers rely more on those sort of adverts, I think then the importance of it to companies increases, and that becomes sort of circular. But the use of Trustpilot data, and they've really tightened up on their sort of pricing model and everything as well, but companies really like embed that in their systems and their operations, and that's how it becomes very sticky.
Yeah, no, I think you're right. Mining that data could be that unique data could be fantastic for them. Okay, in the same sector, we've got John. He's asking about Next 15, which again was a bit of a darling a few years ago. I think it's a media consultancy business with large contracts. I think it did put the slide rule over Saatchi and Saatchi, M&C Saatchi at one point. I think that was a long time ago. And then unfortunately lost a big contract in the Middle East, Mach 49, I think. How do you see this one? Because I think when we last spoke, it was looked a turnaround opportunity.
Yeah, and I think it still potentially could be, but things have definitely got tougher for them on a number of things. So the business is now really in a restructuring aspect. So your view from here is partially on how successful they are in that restructuring, but also the headwinds that have gone against them, can those reverse? So if we look back a while, the first sort of thing was just that discretionary spend, and these guys have a lot of spend from big customers in the tech space in the US. It is more diversified than people think probably, but that was tougher for them. Sort of spend on this whole sort of advertising space was tougher. New product generation has been tougher as well from their customers. Then they had the sort of contract loss, and unfortunately that came from a business which they had acquired and had a big earnout on. So that's been one of the things that investors really haven't liked, is that you've paid a big earnout to a business which then the contract has been lost. And I don't think they did anything wrong with that contract. It was out of their control. It was part of a much bigger thing that got cancelled. I think the other challenge though that I see for the business is actually some of this AI aspect. So I think that's created a sort of new question mark as to how dependent people are on businesses like this now. And actually, could you sort of the creation of new competitors? Could that potentially be occur much quicker because of the use of AI?
Absolutely. I mean, not only the creation of competitors, but it just becomes a competitor, doesn't it? And then your marginal type of lower value added activities could just get totally replaced by AI quite quickly. And the argument that which the people push back is that you then use the existing staff who use our AI to augment their services, to increase the quality and move up. But that process can be quite difficult because you've got to educate your customers, isn't it? But
yeah, and look, it's really cheap if you look on a PE metric. So if you believe that actually their sort of restructuring cost cutting program goes well, and you believe that end markets improve a bit, and maybe the AI isn't such a threat or takes quite a while, then there is potential that these shares could do quite well from here. But
okay,
it does have challenges.
Okay, I know to stock you down arse, but a guy called Bermuse, he's asking about Gooch and Houseco. Anything about it? No, forget it.
Follow it.
Okay, let's move on to another one you've got with the AI. Let's go to Gamma Communications. Now, it's sort of like an expert in all things sort of call center and software and services, and I think it also does a bit of cyber as well. Moved from the AIM to the main market just recently, and I guess the sort of question is their heartland, their call centers to largely corporates, I guess, and a bit of public service maybe. Is that potentially at risk by AI with all these chatbots and things coming out and stuff? But how do you look at it?
Gamma isn't really a call center business. It's much more about providing the telecoms internally for companies that companies need to operate.
Yes.
So no, actually, I don't worry about AI for this one. If anything, it becomes more of a product that they can embed and offer to customers in terms of product service operations. So look, Gamma's been a bit weak lately. I guess they've talked a bit about UK being a bit slower. And these guys, so they have a lot of sort of SME type customers, and then they have enterprise customers as well, and just in terms of size. And there's been a bit of softness in that SME type space. Now this is essential services for businesses, but just in terms of sort of investing more or upgrading has perhaps been a bit slower as companies have been dealing with other things like NI increases and everything. The thing that is accelerated, I would say, is the European proposition. So they've done some really good acquisitions in that space, and I think if you look at areas like Germany, for instance, in terms of sort of cloud telephony and all these things, it's actually quite far behind the UK. So I think there's a real opportunity there in terms of as they take on new services. One of the things I like about Gamma is actually how in recent years what it's sort of done is it's realized they don't need to develop all these products and services themselves. They can just embed other things like Teams, for instance. So I think in terms of then the sort of CapEx spend, R&D, I think it's got a really, really effective business model now. It uses the channel a lot as well for Salesforce. I think some of the recent weakness as well, there's been probably a bit of technical volatility about the whole AIM to main move, but I think that's a positive that they've done that.
Yeah, but let's just hypothetically say, let's say I was a SME, small medium-sized company, and I outsource all my call center and my services, essential services fully to Gamma, etc. Now, if I wanted to save costs, then presumably first-line call center stuff, I could just get an AI chatbot to do that for me, and then only do the second line and third line with Gamma. That would be my only AI sort of like play on it. It's the lower level stuff that maybe could be potentially at risk.
Yeah, I mean, I don't really think of this as sort of people outsourcing stuff to Gamma. Okay. I think of it as Gamma providing the stuff that they need in-house.
Oh, I see. Right. So it's not customer service. It basically doesn't do the customer service. It gives effectively its services give to the company that then does the customer service.
Yeah. So if you're an SME, then you would use Gamma, for instance, to provide all of your sort of connectivity services that you need for your business to operate.
Okay. Cool. All right, brilliant. Okay, let's move on to another sector. Let's go to house building. We've got Claire. She's asking about Bellway, which came out with some nice results, which was a bit opposite to, I think it was Berkeley or Barclay last week, and also Crest Nicholson was a bit weak, and I think you've got Gleason was also a bit weak. So it's a bit patchy in the house building, but they came out with some very encouraging sort of sales figures and stuff. How do you see this one? It's not a small company. It's about just over 3 billion.
Yeah, you're right. It has been quite mixed in the sector, and So look, people are looking at the house building sector because they feel that that is an area that, you know, is now on a recovery pathway. And if we look back in the end of 2023, would have been Q4 in 2023, and people got really positive about the sector very quickly, and they sort of all spiked up a lot on hopes of interest rate cuts and activity and things.
Yes.
And it was a bit of a false start.
Yeah.
What we really wanted to see for investing in this space was actually more of a stable base, let's say, and then hopefully closer to that recovery period. So, you know, Bellway's been a newer addition for us. I think one thing we've seen is probably Bellway had sensible expectation setting. So I think they had the numbers in the right place. They weren't being over optimistic about things. They haven't had any of the sort of stock specific aspects that perhaps someone like an MJ Gleeson has had, some of the others you name. And if you look in the sort of mid space, Bellway is the sort of pure play, I would say, because the other ones of the market cap, you know, you've got MJ Gleeson, Crest and Vistry are sort of the three. The rest are all probably FTSE 100 now.
Yes.
So yeah, I think Bellway for me is the sort of clean play on that housing activity improvement. And importantly, you know, forecasts aren't aspirational on that recovery, which I think is key. But also, if you look at the sort of return metrics on Bellway, I think they're really impressive. So yeah, it's one that we think could have a sort of I think it could have a bright 12 months in front of it, but I also wouldn't get too excited about how quickly this sector might take off.
Yeah, and I think it only trades at just less than book value, doesn't it? Yeah. So you know, it's pretty cheap to say the least. Okay, let's move on to the bowling operator. We've got a Hollywood Bowl, does 10-pin bowling in the UK. It's also expanding into Canada. Has done pretty well of late, other than it did have a sort of softer start to the year because of the warmer spring and I think the later Easter and stuff, and they were saying that their forecasts are going to be more back end weighted and stuff. Shares have sort of like come off a bit. Is this a buying opportunity, or is this something just to be wary of?
Yeah, I mean, I think we haven't been concerned about the sort of long-term investment case on this one.
Yeah,
these guys, look, when we're all celebrating when there's a sunny weekend, they don't like that so much.
Yeah.
So, you know, that's the nature of it, and that's always been true. So it's something that investors, you know, if that surprises them, then they sort of haven't looked at the history of this business.
Yeah.
I think, look, it's another one which I would say the sort of financials, the return metrics, everything like that are just so positive on this business. It continues to have actually a really good sort of value for money offering versus other leisure activities. It tracks the whole family. It's got it's seen as a like tenant of choice.
Yeah.
If you look at who people want to operate, I think they're very disciplined on how they expand and how they invest in CapEx. Really top quality management team. And I think Canada has been a great new geography for them. So yes, look, it definitely has its differences versus the UK, but they've been sensible about how they've therefore entered that market and the expertise they have locally there.
Yeah, and I think also there's a bit of has been consolidation, isn't it? Because 10 Entertainment got bought out by private equity about 2 or 3 years ago.
Yeah,
so,
exactly.
Yeah,
I mean, it's a bit of a consolidated market, but yeah, there's definitely been private equity interest.
Good. Okay, let's move. Chris is asking about Johnson Services, which basically does sort of like cleaning and rental of not only blue collar sort of workwear, but now more so sort of like linen and sheets and towels and stuff for hotels and caterers and stuff like this. I think that, if I remember right, I think the shares have done pretty well. How do you see this one progressing?
Yeah, no, they have been good. Yeah, so this is a stock which I think is now proving its execution and proving its quality. And for instance, if you look just at how well they've dealt with a lot of the sort of energy cost changes that they've seen and all these sort of, you know, I think they're very, very good operationally at managing their business. And another great management team, actually CFO is retiring, but the CFO from Treatt is moving to Johnson Service Group.
Oh, see, right.
Really, really rate him as well. So it's great that they've got sort of a good quality replacement there. It's a business which consolidates. So acquisitions have been very strong for them. You know, this is an industry you want scale. And they're definitely doing that. They've invested in new capacity at Crawley, which has just opened as well. So we would hope that this is like a long-term quality compounder.
Yeah. Are they able to absorb all the NI increases for April? Because obviously that's going to be an issue. We've got sort of like quite a large workforce.
Yeah, and I mean these guys have invested in sort of areas of automation and things like that, which help them. And look, they're also in an industry where they are the biggest scale player. So the people you're competing with in terms of pricing and everything are probably more exposed to hits like that than they are.
Yeah. Okay. Good. All right. We got Paul. He's asking about Renew. It's basically Renew, which does this sort of essential services for sort of like nuclear and rail and other infrastructure around the UK. It used to be an absolute darling. I think it's 10 bagged over a sort of longer term. Had a bit of a sort of like a reset just recently, but the shares have started to increase. What sort of attracts you to this one?
Yeah, so I think what attracted us was definitely the visibility that everyone thought and believed and hoped they had, and they always had, and that's because of the maintenance element. So it's a bit, you asked about one of the others about visibility before. These guys have a degree of visibility, but what they have is loads of repeatability.
Yeah.
They don't necessarily always know exactly what work they're going to be doing tomorrow, but they know it's going to be something. Just if you think about the sort of ongoing maintenance on the railways, for instance. And the thing that's hurt them is just the more discretionary stuff in rail activity at the moment, and areas of government spend. So that was a disappointment, and that's what's happened is like people thought this was your reliable play in this space, and then it's obviously had this hiccup. I think it is a hiccup though. I think that we've sort of seen that correction. I think it's still a really good long-term quality business. I think it's continues to grow and do bolt-on acquisitions. And I think they position themselves in interesting spaces as well. So, areas like water and power and things where you look at the spend that's going to happen in these spaces, and it's set for strong growth opportunities. So, the total addressable market is pretty attractive. It's a real, I would say there's a real element of culture as well about this business in terms of, it's made up of different sort of individual businesses, which are kind of clustered together a bit. But there's a sort of entrepreneurship that you get within business.
Yeah. Is there any risk on the sort of spending review if the public sector starts sort of like cutting back and tightening budgets and stuff like this? Or is this really sort of like, I don't know, as you say, essential regulated maintenance work? Yeah,
a lot of it is that maintenance element. And I think also if you look at the end markets, there are areas that you probably feel more comfortable that a spending review are still areas of focus.
Okay, good. Let's switch sectors. We've got Mary. She's asking about Cranswick, which I know you talked about last time as a long-term compounder, and then it had a bit of an unfortunate sort of like a bad press article which came out. I think it was the Mail on Sunday or something, talking about a pig farm in Suffolk, etc., with treatment of animals and stuff. Anyway, that seems to have sort of died its death, luckily. How do you see Cranswick going forward?
Yeah, I mean, I just stick to my guns on Cranswick. Absolute long compounder. I think this is a must-have in any small mid-cap portfolio. Shares recovered really quickly after that.
Yes.
I think they were, really disappointed to see that as a management team, but they were also all over it very quickly. It was from an acquisition that they'd made that they sort of, had sort of just got their hands on. If you look at the date of that video, it was from some time ago.
Yeah.
So we've been really pleased in this. I think if you look at the growth potential in this business, I mean, it's grown its dividend every year for, I don't know, over 35 years or something now. I think it innovates in a way that its competitors just don't. Its competitors are highly indebted generally, are sort of underinvested private equity businesses. It is by far the leader in its space, and retailers want to work with them for their innovation. They're also sort of expanding into other things. So, I mean, many years ago, the sort of new thing was the poultry side of the business, and that continues to do really well. And I hope that they get planning for future capacity expansion there. The pet food business is a new angle for them as well. So also one I would just, if you have to rate your sort of highest quality management teams, these guys are absolutely up there.
Right. It's on about 19 times, PE. What's sort of the EPS growth rates you'd expect on this one?
Yeah, so I mean, I think it can vary a little bit, but I think this can be a sort of high single digit compounder. And I think you have to think what you're paying up for in this business in terms of just visibility, repeatability, also total return.
Mm. Yeah, because I mean, if you've got basically a PE of 19 and you've got EPS going up high single digits, it's a PEG ratio of 2, which just feels for me as a sort of GARP investor not that cheap. But is it that they're going to beat their under-promised expectations, their conservative expectations?
I mean, they're very good at managing, expectations, and they're very good as well at dealing with headwinds and challenges. Operationally, and like I think their addressable market. This is generally a UK business. But their growth they can achieve within that, just in terms of how much retailers really want to work with them and the level of innovation they have, and also their operational improvements. So you talked about an eye for someone else. These guys have really invested in automation as well. So if you compare them to their peers, I've been to see one of their facilities and it sort of blew my mind.
Okay. Okay, brilliant. Well, there's one tough question I ask all our experts right at the end is what's sort of like the your favourite stock for the next sort of 12 months? This thing that's another one that people perhaps should put onto their watch list to go away and research. Maybe something we've discussed already or something else. Anything to sort of highlight to investors?
Yeah. I mean, I feel like we've just talked about this one, but I think Cranswick would be one I'd absolutely put up there, because I think that you have to be aware of the level of macro uncertainty that we have at the moment. And there are sort of increasingly, actually, areas of downgrades across various sectors. So I think if I had to I think you've got a risk of putting all your eggs in one basket at the moment. So yes, look, some of these sort of recovery stocks might have a really great 12 months, and we talked about some of the housing. So something like Bellway might have a great 12 months in front of them. I would certainly not bet against Chemring and Avon, and defence space still having a very good period. But I think that if you have something like Cranswick, I rely on that in terms of just that long-term quality compounding.
Brilliant. Okay, well, thanks very much, Abby. Some terrific thoughts and ideas for people to go and research. Indeed, I might well go and get on a jet to city break and try that one out in my next holiday with my wife. It would be very good. So thanks very much, everyone, as well, for your questions, and look forward to touching base in about 6 months' time, Abby.
Yeah, thank you so much for having me, Paul.